Today, we're diving deep into a company called Tradeweb. Now, these guys operate right in the engine room of the global financial system, and they're powering this huge shift in how trillions of dollars change hands every single day.
So let's just start with a big idea. What if you could invest, not in the stocks or bonds themselves, but in the essential high-tech infrastructure that makes all of it work? The actual plumbing of modern finance? Well, that is exactly where Tradeweb lives.
The entire Tradeweb story is really fueled by one massive trend, and it's called electronification. Basically, it's this unstoppable move away from the old days of traders yelling into phones to making trades instantly on these super smart, data-heavy electronic platforms. It's all about making markets faster, cheaper, and way more efficient.
And listen, this isn't some far-off theoretical thing. Just look at one little corner of the market, high-yield bonds. You can see right here that in just a decade, electronic trading has jumped more than 5 times over, from just 6% to over 32%. I mean, that's the kind of explosive growth that acts like a massive tailwind for a company like Tradeweb.
Okay, so let's jump into our first section here and really get a feel for the sheer scale of this whole transformation.
To really get the opportunity here, you first have to understand just how big this playground is. The U.S. fixed income market, that's bonds, is a nearly $28 trillion space. It's absolutely colossal. And every tiny fraction of a percent that switches from the old phone system to a new electronic screen represents a massive opportunity for revenue.
So you might be thinking, okay, this shift is probably almost over, right? Well, not even close. This chart shows we're really still in the middle innings of the game. Sure, a mature market like U.S. Treasuries is over halfway there, but these other crucial growth areas, they still have a huge runway ahead. That big room for growth slice, that represents trillions of dollars in trading that still needs to go electronic.
So let's move on and take a look at how Tradeweb has actually built this incredibly powerful and profitable business on the back of this huge trend.
All right, so how do they actually make their money? This little breakdown is so important. The biggest chunk, over half their revenue, comes from what they call rates. Think government bonds. This is their stable cash cow foundation. But the really critical part for an investor is that second slice, credit. That's the high growth engine, and that's where the company is really pointing its cannons right now. So why can't some hot new competitor just show up and steal all their business? Well, it comes down to what you'd call a powerful 3-part moat. First, you've got the network effect. With over 3,000 clients, everybody wants to trade where everybody else is trading. Second, they are wired deep into their clients' day-to-day operations with automated tools. And third, just the sheer scale of their tech. Built by over 400 specialists, it's just incredibly hard and expensive for anyone else to copy. This quote really nails the heart of their competitive advantage. See, when your software is a core part of how a client does business every single day, leaving isn't just about finding a cheaper price. It means you have to completely re-engineer how you operate. That creates what we call incredibly high switching costs, which basically means their customers are super sticky.
Okay, now let's get to the really juicy part of the story, the all-out battle for that super lucrative credit market. Now, this isn't just one company against another, it's really a battle of technologies. Tradeweb's main competitor, MarketAxess, kind of builds its name with a tool that's great for hunting down one single, hard-to-find bond. But Tradeweb, they focused on a totally different problem. Their tools let giant institutions trade huge, diverse baskets of hundreds of bonds all at once. They're built for scale and pure efficiency.
So, which approach is winning? Well, the data is just crystal clear. This little snapshot tells the entire story. Just look at the change in market share over 1 year. In both of the main credit markets, Tradeweb's share is going up, while its rivals is going down. It's not a mystery. Tradeweb is actively taking business from them in the most important growth market.
And hey, this isn't just my interpretation of the numbers. The company's own management team is shouting it from the rooftops. They have told investors again and again that winning this market share fight is a key reason they're having record financial results. They know their strategy is working.
Okay, so with all that momentum, let's look ahead. How is Tradeweb planning to keep this growth engine screaming down the tracks? Their strategy really has a few different layers. First, keep attacking the credit markets. There's still a ton of room to grow there. Second, push harder internationally, especially in Asia. Third, go after completely new kinds of customers, like the people managing cash at big corporations. And finally, you have to stay on the cutting edge of tech, and that means AI.
Let's look at a perfect example of this strategy in the real world. In 2024, Tradeweb went out and bought a company called ICD. This was such a smart move because ICD's whole business is serving corporate treasurers. So boom, overnight, Tradeweb had access to a brand new type of customer.
And the result of that purchase? An immediate, absolutely explosive impact. The very next year, revenue in their money markets business shot up by over 130%. I mean, that is a textbook example of a smart acquisition directly fueling incredible growth. All right, let's pull all of this together in our final section and really look at it from a pure investment point of view. What's the final verdict here?
There's just no way around it. A high-quality company that's winning like this, well, it's going to come with a high stock price. So the big question for any investor is, does the amazing performance actually justify paying that premium?
This little side-by-side chart really answers that question for you. Yeah, Tradeweb trades at a higher price, a PE ratio of about 32 versus 24.5 for its rival. But then you look at the top line. Tradeweb is growing revenues at almost 29%, while MarketAxess is actually shrinking. The market is always willing to pay more for strong growth, and in this case, that premium seems pretty well deserved.
But of course, no investment is risk-free. For Tradeweb, there are a few key things you've got to keep an eye on. Their revenues can be sensitive to how crazy the markets are. Competition is always going to be fierce. As a tech platform, cybersecurity is a constant threat. And finally, their majority owner, the London Stock Exchange Group, could always make a decision that affects the stock. So the bottom line is this. All the evidence shows that Tradeweb is currently winning the race to build the future of finance. They have the momentum, they have the tech, and they have the right strategy. So the multi-trillion-dollar question for any investor is simple. How long can they stay in the lead?